Let's talk about stocks. You've probably heard the terms thrown around: the stock market, Wall Street, investing. It can seem intimidating, but the basic idea is pretty straightforward, and understanding it is more relevant than ever, especially here in the US. So what is a stock? Simply put, when you buy a stock, you're buying a tiny piece of ownership in a company. Think of a company like Apple or Google or even a smaller business. They need money to grow, to develop new products, expand into new markets, hire more people. One way they get that money is by selling shares of ownership. Those shares are stocks. Why is this relevant to you? Well, historically, investing in stocks has been one of the best ways to grow your wealth over the long term. It's a way to participate in the success of businesses and potentially benefit from their growth. Of course, there's also risk involved, which we'll touch on, but let's focus on the basics first. Let's walk through the steps of buying and selling stocks. Step 1. Open a brokerage account. Think of a brokerage like a bank for investing. You'll need an account to actually buy and sell stocks. There are lots of options out there: Fidelity, Charles Schwab, E*Trade, and increasingly, app-based brokers like Robinhood and Webull. These app-based options often have lower fees, which is a big plus, especially when you're starting out. You'll need to provide some personal information: your social security number, address, and employment information to open an account. Step 2. Fund your account. Once your account is open, you need to deposit money into it. You can usually do this through a bank transfer or sometimes with a check. The amount you deposit will determine how much you can invest. Start small. You don't need a huge amount of money to get started. Step 3. Research stocks. This is where the work comes in. Before you buy any stock, you need to do some research. What does the company do? How is it performing financially? What are its future prospects? Look at things like revenue, profit, and debt. Read news articles and financial reports. There are tons of resources available online to help you with this. Don't just blindly follow recommendations you see on social media or hear from friends. Let's say you're interested in Tesla. You'd want to look at their quarterly earnings reports, see how many cars they're selling, and understand their plans for future growth, like their work on electric trucks or battery technology. Step 4. Place an order. Once you've decided on a stock you want to buy, you can place an order through your brokerage account. There are different types of orders. A market order tells your broker to buy the stock at the current market price. A limit order tells your broker to only buy the stock if it reaches a certain price. Let's say Tesla stock is currently trading at $250 a share, and you want to buy one share. You could place a market order, and your broker will buy it immediately at whatever the current price is. Or, you could place a limit order to buy it only if the price drops to $240. Step 5. Monitor your investment. After you buy a stock, it's important to monitor its performance. Keep an eye on the price and read news about the company. Don't panic sell if the price goes down. Stock prices fluctuate all the time. But if you see a significant change in the company's fundamentals, it might be time to reevaluate your investment. Now let's talk about selling. The process is very similar to buying. You simply place an order to sell your shares through your brokerage account. You can use a market order or a limit order, just like when you were buying. Let's say you bought one share of Tesla at $250, and now it's trading at $275. You could place a market order to sell it immediately at the current price, or a limit order to sell it only if it reaches $280. It's important to understand that stocks can go up and down in value. This is called volatility. There's always risk involved, so you should never invest money you can't afford to lose. Diversification is key. Don't put all your eggs in one basket. Invest in a variety of stocks, bonds, and other assets to reduce your risk. Another strategy is dollar cost averaging, investing a fixed amount of money at regular intervals, regardless of the stock price. This can help you avoid timing the market, which is notoriously difficult. So to recap, Open a brokerage account, fund it, research stocks, place an order, and monitor your investment. Selling is essentially the reverse process. Remember to diversify, consider dollar-cost averaging, and understand the risks involved. Investing in stocks is a long-term game. Don't expect to get rich overnight. It requires patience, discipline, and a willingness to learn. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.